Welcome to the NISM Masterclass. I am your host Sashi Krishnan. Our purpose at NISM is capacity building for the securities market ecosystem. And as part of that purpose, we sit down with the gurus of the securities market to gain a deeper insight into the various facets of the securities market and their journey. And as part of that conversation, my guest today is Amit Tandon. And Amit is the founder and managing director of Institutional Investor Advisory Services, that is IIAS. IIAS provides recommendations on shareholder resolutions for over 1,000 companies, representing around 95% of the total market cap in India. And it also does independent research on governance, ESG issues, and a lot of other areas. Welcome to this masterclass, Amit.
Thank you very much. Thank you for inviting me, and thank you for that introduction. My mother would be proud of it. I don't think anyone's ever called me a guru before, so
Right.
I'm happy to hear that.
Yeah. So Amit, over the last 10 years, and you've been engaged for slightly more than that, both in your avatar when you were running Fitch in India and, in IIAS. Shareholder engagement with companies has, increased significantly. It's moved on to a new level. And initially it was only passive voting, and then from passive voting it has now moved to, active engagement on issues like, executive compensation, related party transactions, board compositions and things like that. So what in your opinion has been the catalyst that has resulted in this increased engagement that we are seeing? You have in the past mentioned that some of the reasons is that today everybody can vote, unlike in the good old days where you had to turn up at an AGM to vote. Similarly, they have introduced this majority of the minority vote in many of the resolutions that need to be passed. Similarly, SEBI has introduced the Stewardship Code for institutional investors and many such things. But what in your opinion are the key catalysts for this increased engagement?
So, Shashi, when I kind of look at it, I think there are three trends which have been shaping the governance debate. The first is the regulations themselves. The second is the changed shareholder share ownership structure. And the third is presence of firms like ourselves who've kind of been fairly vocal. Proxy advisors who've been fairly vocal about what's going on. Now, you've touched upon some very key issues as far as regulations are concerned. The fact that, you've got now e-voting, so each vote is counted. You've got resolutions like majority and minority, so it kind of puts the promoters on their toes.
So the majority of the minority is required in what kind of resolutions, Amit?
So it's typically required for related party transactions where you do have someone who's an interested party who does not get to vote where they're interested. But if you kind of look at regulations more broadly, the Companies Act focused on what is independence and the roles and responsibilities of independent directors. The regulations, while I kind of talk about regulations, it will include both the Companies Act as well as what SEBI has been doing through the LODR and more generally through their various regulations which come out from time to time. They've also focused on the roles and responsibilities of the audit committee. They've focused on the roles and responsibilities, as I mentioned, of the board. And if you kind of, in that sense, look at the arc of regulations, it's kind of shifted from what the company is supposed to do to what the ecosystem is supposed to do. And a large part of that, again, is what is the roles and responsibilities of the investors. And to that extent, they've rolled out the stewardship codes. SEBI was there, IRDA, the pension funds. You've been kind of party to a lot of this conversation, and you've seen the evolution of a lot of this. So, if you look at stewardship codes themselves, one way is to say that, look, you're supposed to vote, but it's much, much broader in the sense that you're supposed to, have engaged with companies. What you engage on is what issues matter to you. Why do they matter? You're supposed to disclose that. So there's this whole change which has taken place. So one is the expectations from companies, the KMPs, the boards, the audit committee. The second is the changed expectation from the investors. That's also large. The other aspect, as I mentioned, was the ownership structure. Now, if you go back to the time of the financial crisis, or just around that time, the promoters held 30% of the equity, the institutional shareholders had about 20% of the equity. Therefore, for every one share the institutions held, there were 3 shares which were held by the promoters, and therefore they weren't really a part of the conversation. Today, the institutions hold closer to 30% of the equity. Promoters own about 50% of the equity, so you can see that the relationship is changing. Now, when the funds own about 30% of the equity, it's not unusual for them to own 5, 6, 7% in a company's share. And then when you combine 2 or 3 of them, it's about 15, 17%, which cannot be ignored. And that combined with stewardship has made a difference. And just to pull up a phrase which we used, you go back 10 years, what you saw active investment, passive engagement. There's a shift which is taking place where everyone's kind of tracking the index. So you've kind of moved to passive investment, active engagement. So that's a big change.
So let me pick up this word active engagement, because I mean, what does this word active engagement actually mean? Because one is about having conversations with company management, company promoters, which I mean most people have conversations over quarterly results because there is so much of disclosure that need to be made, or they have one-on-one meetings. But does this active engagement go beyond that?
So we'll look, usually when you kind of talk about activism or active engagement, you have companies like Bonfire of the Vanities or Barbarians at the Gate, where you think there's someone who's going to come over and take over a company and move and shake it and so on and so forth. I think we're kind of moved, we are in a slightly different orbit, and we are in a slightly different orbit primarily because of the ownership structure. If you have people owning 50% of the or 60% of the company, it's very difficult to kind of have your, to push and kind of make significant change. So what you do have is that they kind of engage on issues, whether it is in terms of slightly different disclosures, whether it is with regard to policies, or what they push managements to do is that, look, we want you to explain yourself a lot better. Once management start to explain themselves a lot better, they realize that, look, we've not been doing it, we need to, and once you kind of start articulating yourself, maybe you feel you need a different policy. But having said so, there have been, I keep saying that, the US business activism was built on the fact that you don't have any promoters there. So one of the strengths of the Indian capital markets is the fact that you've got so many promoter-controlled companies. And I say it's a strength because it enables businesses to take a generational view about what's going on. So we think it's nice. You're not necessarily worried about what's happening in the immediate quarter or 2 quarters down, but also can take a slightly longer view because you're looking into the room and saying that, look, we've got family members and you've got a generational view about how to think about some of these things.
So when we talk about activism, we sort of tend to imagine it as a more assertive approach, where shareholders seek to directly influence decisions that promoters and managements are making. Do you think, given the fact that we've had quite a few cases in the recent past in India where shareholders have been a lot more assertive in terms of asking for things from management or trying to change the management also in many cases. So do you think that, that there is a case where minority shareholders' interests are not being protected in India, that there should be more activism?
So look, Sashi, 2 things need to happen. One is you have to have entities where there is no identified promoter. Right. So you've got, they're professionally managed, institutionally owned businesses. And the second is that the financial performance is very poor. So, as and when our ownership structure changes and you have more professionally managed, institutionally owned companies, you will see a slight change in the form and shape this takes.
Right.
But as long as the overarching ownership structure is that it's going to be, businesses are going to be promoter controlled, it will not happen. Now, on the other issue of, what, for want of anything else, let me just say professionally managed and owned companies, we're kind of seeing that increase. So 5 years, 8 years ago, you could say that, look, it's L&T. Some would include ITC in that bucket, others may not. ICICI, HDFC. Today, that number is slowly increasing. And then you've got a slew of private equity funded companies
right. Exactly.
where, the promoters own less than 10%.
Right.
And, the private equity, and so far the private equity supported the promoters. But, they'll exit, the promoters will get diluted down or sell. And therefore, you'll see a lot more of these going forward. So it's going to be an interesting space to watch in terms of what form and shape it takes. But clearly,
so let
regulations
me pick up on,
also have to recognize this change.
So let me pick up on that idea, Amit. So as you had mentioned, and the NSE study, in fact, they did a research report that came out just a few days back, where they talked about the fact that in the NSE 50, the promoter shareholding has now dropped to below 50%. So, and the institutional holding, both foreign and domestic, has gone up to something like, 35% or so. And the retail investors also now have a substantial stake. So, promoters now are less than 50%. So, is this changing the nature of corporate governance? Because as promoters' stake in these companies keep coming down, is it that they are now more amenable to listen to, institutional investors, retail investors in terms of some of the decisions that they take? But more importantly, has this had any impact on corporate performance, this, increased engagement and this increased activism?
Sure. Look, we track this number, and we actually track a slightly different number, which actually pull the data out from the NSE itself.
Right.
Which is that, what matters in our business is the voting.
Right.
So there's a slight difference between the market cap and the, if you count versus counting each share. Mm-hmm. Counting each share gives you the promoters a slightly higher ownership, institutions a somewhat lower ownership, but nonetheless, if you look at it in terms of the trend which is there, it's there, that the institutional ownership is coming down, and the promoter institutional ownership is going up, and the promoters are kind of coming down.
Right.
Yes, I believe there are two things which have changed. Partly, of course, when you own less of the business. The second is, as you move from one generation to the next, people who have a kind of feel for the business, is less obvious than in the first instance. And I keep saying, as you move from the father to the brothers to the cousins, you kind of see the change. And you've got a slightly lower, I own, as the father, I own 55% of the business, as the brothers. And I say brothers, I know that's also changing, and there is a gender diversity, right. But I was consciously saying that for most, it has been brothers. We are kind of starting to see changes now when the girls also have started to inherit the business, and that's a welcome development. But from 55% it becomes 27.5 each, and then when you move on to the next generation, it's about 1375 each. So therefore, as my ownership comes down, I'm looking for other businesses or other avenues, other ways. The buy-in comes down. So therefore, you're saying that okay, you've got another shareholder on the other side where you would expect there is an alignment of interest, because what's good for a 50% shareholder has to be good for a 25% shareholder, and which has to be good for a 12.5% shareholder. So you kind of say that, look, there is an alignment of interest, let's hear. I'm not saying they always act on what is being done, but at least they're more open, people are talking about it, and we also need to look at somewhat of a change. So earlier, when we started off in 2010, 11, it was the global investors who were a lot more vocal and talking about things. The Indian investors tend to tiptoe around issues.
Right.
That no longer happens. You find that the domestic investors too are very open and very vocal about what is it that they want. Now, it's not that all funds have deep relationships with all companies, but it's not unusual then for some of the larger funds to have a deeper relationship and to that extent a deeper engagement with some companies. So they have a pretty good idea in terms of what the business is, what the strategy is, and therefore are able to understand and kick it around to see does it work, does it not work, and they're asking those questions which might make promoters or get them to rethink the path they're following and say, okay, do I need to whether you say pivot or just change the direction a little bit is all now par for course.
So there's an interesting point that you threw up, Amit. So if as promoter shareholding keeps coming down, this distinction between promoter and management is now becoming a little more stark. Previously, it was a very blurred kind of distinction. Promoters, management, they were all treated as one. With this distinction coming in, the engagement that institutional investors have, is it with the management or is it with the promoters now? What is your sense?
It's mainly with the management.
With the management.
Whoever is running the
Correct.
business.
Correct.
So you may be a shareholder, but you're not on the board.
Right.
Sorry, you are on the board, but
Right.
you're not running the day-to-day operations. So I'm going to speak much more to the person who is
Running the business.
Day-to-day running the business.
Right.
Yeah.
Okay. So that brings me to my next question, that now there are a large number of promoter-less companies. So though promoter shareholdings have come down, there are a large number of companies where the promoter shareholding has dropped to below 5%, right? And we did a run on a data run, and we found that almost 162 listed promoter-less
I'd love
companies.
for you to share that
Yeah,
data.
we will
It's
share that
something
data.
which is
Yeah.
Something
Yeah.
which is I've been tracking for a while,
Yeah.
and I think
So-
it's going to change the dynamics of
Correct.
the Indian market. So it's very
Exactly.
important.
So where the promoters stake is, nil to almost less than 5%. So are these companies more professionally run? Because here it is only the management that is running these companies. So that's my first question. And the second question is from a financial performance perspective. Our interpretation of the data seems to suggest that they are not very significantly better off in terms of ROE and ROC than promoter driven companies. In fact, if you look at it on aggregate, the promoter driven companies seem to have better ROC and ROEs than the promoter less companies. So I just wanted your thoughts on both these issues.
Look, I haven't looked at, our sense is that the number of companies is significantly lower, and therefore, but we've not kind of looked at this breakup. But what you say does make sense because, as you expand, and it comes from the first question you asked, that are they more professionally run? I'm not sure I will kind of buy into that. I think, some of the warts which you see in promoter-run companies are very obvious in some of these, and the promoter is comfortable in terms of where they're sitting, that they've got a significant shareholding, and therefore they know that they can influence decisions. But here you kind of see some degree, because you don't have significant shareholding, you also tend to bristle a little bit more and tend to be, assert yourself a lot more than if you had a significant shareholding in the company, or your father or grandfather's name was on the board.
Right.
So no, I think I would not buy into the argument that because you have low holding, you're going to be better run. And the other is that just because you're professionally owned and managed, you're going to have better financial results. Of course, as with all things, as the sample size keeps or the data size increases, you will be able to pull out and say that, look, this is a family owned company, well governed, better margins, or this is a family owned company, badly run, low margins, and on the other side as well, professionally owned, better margins, professionally owned, badly run. So you'll kind of start to see that. So we have to be careful in terms of drawing inferences based on individual companies, because we'll now be able to get all examples.
So on the same lines, Amit, You have a whole set of new age companies that have been sort of, where you have private equity that has invested into these companies, and then the private equity still continues to hold, or the private equity funds still continue to hold a substantial stake in these companies. And they also sometimes have board seats, because that's the way these deals are negotiated. How does that impact governance in these new age companies?
So look, at the end of the day, what we have to remember is that, it's the time horizon you're looking at.
Right.
So, earlier I spoke about the fact that, look, you've got the promoters and they have a generational view of business. Now, if you turn around and you go back, private equity doesn't have that horizon. And, their decisions are driven by when is their exit.
Correct.
And they will want to maximize at the time of where their exit is.
Correct.
In fact, if you look at, some of the so-called startups which got listed, and you look at some of, what they came out, put to shareholders to vote, and one of the things which you referred to was, seats on the board.
Right.
And you look at their behavior, which is the private equity, which always supports these resolutions, versus the market players who say that, look, we don't necessarily need it, and they believe that it's the market forces which are going to help discipline, if I may use that word, some of these companies. So we believe that market is a far better discipline than when you have private equity. In all these instances, what we say is, in times of a crisis, you do need a strong board. Maybe, some checks and balances are needed on the promoters. There's a bouncing board, or you have someone who you can bounce ideas off who's there on the board. But otherwise, if you've got a good board and a good governance structure, you've got strong processes, we don't believe there's any value which will be added by private equity in companies which have, are ready to go to market or are in market. Maybe at a different stage, early stages, you might they might add value.
So talking about the board and something about what you said a little bit earlier, has the role of the independent director changed over time? Is the independent director, in the true sense of the term, independent, and is he contributing a lot more to governance today?
So look, earlier I don't think the independent directors, he or she, saw any responsibility. They just kind of saw it as, we're going to go into the company, look at what is happening. I think the roles and responsibilities are changing. The expectations from independent directors are changing. So, it's a little bit odd at this stage that it shines, or it comes out much more in the time of a crisis, that what were they doing.
Right.
So in normal course, you kind of just take it that it's there, it's a hygiene factor, and you would expect that the independent directors do their job. I know there's a lot of views whether independent directors are good, bad, why do we need them, they're friends of, at the end of the day, they're friends of the promoters. So they're not really independent. But I kind of ask another question, which is that if you did not have if you did not have independent directors, will you look at the structure and say that, look, yes, we need something like the office of an independent director? And I think the answer is going to be yes. Now, a lot of it comes from personalities. There are different geographies, some in Europe, some in Latin America, which have kind of experimented with different structures, saying that the promoters nominate them as a part of, put forward the names of who the independent directors can be. The independent
so
directors
they're still
choose.
Independent directors, but nominated by the
No, I'm
promoters.
saying they're different structures, but their kind of names are put forward, but the majority or minority chooses them, or some have flipped it around, saying the majority or minority gives forward the names, the promoters chooses them, and so on and so forth. But my experience from what I've read in the literature is none of these work.
So there's no one good way to get an independent. There's no one good way.
It depends on a lot on the personalities, and it depends a lot on the dynamics in the room, so to speak.
So while talking about board of directors, there was another thing that came to my mind. And that is the SME companies. There are a large number of SME companies that are either getting listed on the alternate exchanges, or then some of them even going to the main board. And over there, obviously, there is a greater expectation in terms of, the quality of the board and the governance that, you need around these companies. So what's your sense, and how should this improve?
Okay, I think a lot of it comes from transparency, right, and what is the quality of the accounts, the transparency which is there, and we've been for a long while, for 9 years now, we've been doing the Indian Governance Scorecard. It's something right. We developed with the IFC, part of the World Bank Group, and the Bombay Stock Exchange. And we kind of benchmarked, created a benchmark in terms of what companies should do when they look at their governance practices.
Right.
And we've been kind of looking at the BSE 100 companies for the last 9 years now. And one of our observations is that, look, if you are kind of, a couple of things influence your governance and the quality of governance. One is your shareholding. The more widespread the shareholding is, generally, you expect that the governance will be better.
Okay.
The second is your markets. If you're supplying to global players, you would expect that the governance will be better.
If I may interrupt you out here, you mean to say that the other stakeholders also have a sort of influence on how governance happens?
Yeah. And the third is, the peer set. So if you find that, the IT companies tend to have better governance than, someone who's kind of catering to the domestic market.
Right.
So if I were to just pick up one element of this for the SMEs, you will find that, those who are supplying to larger companies, right? If you're supplying to, let's say, a Mahindra & Mahindra or a Tata Motors, you would expect that their quality of governance, other things being the same, should be better, just as we find that in the IT companies, because they were supplying to a global market, had, and diverse set of investors who are asking you questions, expectations are different, etc., had better quality governance. So that's just one element. So I keep saying that, quality of disclosures, better elements, and who are your peers? Right. If you kind of look at your peers, if you turn around and say, look, my peers are other SMEs, the chance of you're doing something good and great is going to be low. But if you kind of start benchmarking yourself, and I'm not saying that, benchmark yourself against the Nifty 50, though that'll be great. But even if you say that, look, let me look at the 100 or 150 or 200 companies and look at what some of their practices are, it is going to be good for the SMEs and the MSM, and the companies listed on those exchanges.
Right. So from a governance perspective, Amit, there are a couple of challenges, especially relating to executive compensation, which I think I see a lot of proxy advisors repeatedly raising. Similarly, related party transactions. Those are also issues which proxy advisors keep repeatedly raising. And while talking about related party transactions, we also have issues relating to royalty payments, because, very often there is very little logic on how these royalty payments are structured. Are they linked to profits? Are they linked to sales, and so on? So, royalty payments, in fact, have been growing at a CAGR of something close to 15% across, the entire universe of companies. And sales growth has just been around 7%. So, this linkage seems to be, just not there. So, how do you, as a proxy advisor, approach both these issues in terms of executive compensation and related party transactions and royalty payments in particular?
Okay. So let me kind of take, these are all very important issues, and they kind of agitate a lot of market participants. So let me kind of take them one at a time.
Right.
So first is royalty. Right. There is a genuineness to royalty. There is a brand which has been created. There is a lot of R&D which has gone up. It's kind of come to India, etc., etc. So there is some amount which needs to be paid. Now, what is that number? Should it be 3%? Should it be 6%? Is something which is always a challenge. And we've also got stuck in the fact that, when the regulations changed earlier, there was a cap on royalty, etc. And
Right.
it was very difficult for the government to move. And the government decided that, look, we're going to make it a little bit easy for ease of doing business, as well as, you've got a flip side of wanting to attract more foreign FDI. So if you want to attract more FDI, you have to make things a little bit easy. So the government kind of freed up the limits. So what what we grapple with
when you say freed up the limits, there are no limits.
Well, there are, in terms of, they say that if it is more than 5%, you need shareholder approval.
Yeah, you need shareholder approval.
You need shareholder
There are no
approval,
limits,
etc. But yeah, I'm not sure if there is an approval from the central government which is required. But we've not seen anything more than 6% or thereabouts.
Sure.
So I need to go back and check this whether there's a central. But you come back to it. So what we say is that, look, there's a starting point. Now, if you're, what are you paying royalty for? Either it's because the brand, and the brand is kind of enables you to grow faster than your peers or competitors, or there is technology, which means that your margins are lower, or again, it's a superior product which goes to, you should have faster sales. So we turn around and say that, look, are your sales growing faster than your peers, or is your profit growing, or your margins greater than those of your peers? Now, if the answer to those is yes, you can kind of continue to tweak it till you reach a balance between the two. If the answer is no, then of course, there's no justification for you to charge royalty. So we've been tracking this number from about 2013 or thereabouts. Our sense is that, I haven't got the numbers based on the 24 financial results. We're slightly behind the, in terms of updating it. But for, if we look at 21, 22, 23, there was a broad equilibrium out here. So it was okay. But as, SEBI was a little bit more, I know the quota committee put a limit of 2%.
Right.
It went back. It came to 5%. So I just presume it's a discussion in terms of, as an economy, do we need some of these companies, or do we not need some of these companies? And if these companies are in India, should they be listed or not? The answer would clearly be that, look, we need some of these companies in India, and it will be good if they are listed in our market rather than unlisted, so this issue doesn't come up. So royalty is there. It's kind of, by and large, the problem is, it's not as extreme as it was 5 or 6 or 7 years ago. So it's kind of much, the scale of the problem, if I may use the word, is much lower and mostly in equilibrium. RPTs again is something which was a cause for concern when we look at the data now. It's not so we look at institutional shareholder or investor dissent. It's not the top 5 resolutions for dissent. So therefore, again, over a period of time, there have been checks and balances, and the greatest is that it's majority of minority resolutions.
Right.
And therefore, people are a lot more mindful in terms of what they are bringing. What investors worry about is that if there are some dependencies. So I've got a gas pipeline which is owned by the promoter, or by, I'm using it to kind of, get my raw material or push out my finished product. Those are causes of concern, and those, you have to find a way of unwinding it sooner rather than later.
Right.
There may be a price to pay, but wait till then. Those are the ones which are big and which are an area of concern. Compensation is, of course, an area of concern. Over the last 5-7 years, we've looked at the data. Compensation has kind of outpaced both growth in top line and bottom line. And our belief is in part because this is not seen as a related party transaction, and therefore promoters get to vote their own salary. I'd love to vote, give myself the increase I want, just like I'm sure you do, and everyone in this room would want to kind of decide what their compensation is. And there are virtually no checks and balances. So we found that of the 800 odd resolutions over I think a 21-month period,
right.
If you had there were 800 plus resolutions, just 20 of them got defeated.
Okay.
If you had majority of minority, about 220 of them would have got defeated.
Okay.
So you need, this is an area where I certainly believe you need a majority of minorities to come in.
So you were saying that as far as the executive compensation is concerned, there is no majority of the minority requirement over there.
No, there isn't.
There isn't, right?
There isn't.
So
but you have to remember that you have very few promoter-controlled companies there.
Right.
I mean, you do have, some of them in the technology, but by and large, we found that there is a great degree of, the board is able to hold their own. I still remember a few years ago, for Steve Ballmer, they said that, look, we are not he's eligible for, let's say he's eligible to get 100x as performance linked bonus. They said, look, we are giving him 50 because he hasn't done A, B, C, D, E,
right,
which was expected. And in any case, his wealth is tied up to his stocks and not, a few million we give him as compensation. So, it's not that Steve Ballmer then protested and huffed and puffed or whatever. He kind of continued to work and give it. So here also the wealth is tied up to the stocks. So there is this anomaly where they expect that they will get the full compensation. I think there is a case for saying that there's greater clarity in terms of what the deliverables are. And you can't say, the solution which Indian companies offer is 1% of profit. But, if you're in the in a commodities business, 1% of profit means you've done nothing. If the commodity cycle is up, you'll make huge amounts of money. If the commodity cycle is down, then you kind of increase your fixed component. So they kind of find ways around it. But
right,
we believe we need, as investors and as market participants, there has to be much, much greater clarity in terms of what are you paying the compensation for.
So in talking about clarity which institutional investors need to have, you run the SMART platform, if I'm not mistaken, or SMART platform.
That's right.
And this is primarily to support institutional investors in their stewardship activities.
That's right.
So how has the stewardship code as a whole, sort of given a sort of better outcomes, in terms of the overall governance of the systems, and what should institutional investors do to better use this stewardship code and this stewardship framework?
So look, we have to give regulators the credit for, having e-voting, bringing out the stewardship code. So after a couple of years of having rolled out voting recommendations, we started kind of looking at data, and I go back to 2013. First data was a little bit patchy, but primarily we saw that about 13-14% of the shares were voted, 88% was abstained. When you look at it now, you've got about 80% of the shares which are voted. And if we look at the median vote from institutions, it is 88%.
Right.
So it's kind of pretty high.
Right.
All of them have kind of embraced the stewardship code. Of course, it's a question of size. It's a question of when you did it. So it's quite interesting. If those who begin kind of see it as tick the box. If you've kind of been at it for a while and been a little bit more thoughtful, you kind of look at some more complex decisions like, is it, capital allocation decisions, succession planning, etc. And of course the what's happening in the market around you. So one of the funds had this thing saying what they call routine decisions and critical decisions. So routine decisions were those where it need not come up to the CIO. They could, the team could pretty much decide. And one of them was borrowing resolutions. And then suddenly, 2013, 14, 15, you had this crisis where companies had borrowed too much, and that became an issue. So suddenly you find that became a critical decision which needed the CIO's sign off, so to speak. So you kind of see that evolution which is taking place as far as different funds are concerned. I know we use the term institutional investor, but it's also important to remember that they also have different fee structures, different time horizons, which determines how they look at their stewardship activity. At the extreme, you have private equity, which gets the highest fee and has a seat on the board, and therefore they have one view about how you think about things. On the other hand, you have the index funds, which have a lower fees, and they really turn around and say that, look, we're going to buy this stock irrespective of what is happening. But nonetheless, if you think about it, is the index investor who has the most to lose, so to speak. So it's for them to kind of look at what is happening and engage much more vigorously, so to speak, on the governance aspects. Because if the governance is good, if the processes are strong, you would expect that the performance will be much better. Though let me qualify it. Good governance, or it's the converse. Bad governance means you lose money. Good governance doesn't necessarily mean.
So, from what you said, one of the, I think, key outcomes of introducing the stewardship code has been increased voting participation.
Yeah.
Correct. And you also have a platform called Adrian, if I am not mistaken, which sort of assists.
It gives a lot of, we kind of put the data. We kind of put all the data together because we find it's very difficult to kind of look at what is out there. So it's just a way to help.
So let me just break this e-voting part a little bit and say that here before, in the good old days, you used to have an AGM or an EOGM where everything that needed to be voted would come up to the AGM, and then the shareholders would have a discussion with the management and the promoters in terms of what was good, whether it was good, whether it was bad, and the management had an opportunity to present their case. Today what happens is, in e-voting, you seem to have taken, the proxy advisors seem to have taken over that role, and all the voting happens prior to the AGM and the EOGM happening. So is that a good thing to have happened?
Look, what's good is there's greater participation.
Yes, that definitely, most definitely.
That is good. I keep saying our shareholder meeting's dead.
Right.
So because you want to listen to what the management is saying and then decide how you vote. Right. That function is kind of moved to before. I mean, you do have the opportunity to go to the AGM and cast your vote, but most institutional investors now go through the custodian, and therefore their votes need to come in 48 hours or 72 hours before. The other, of course, is, you kind of go listen to what the management is saying, read the body language. Now you've got a number of other opportunities to do so. There are a host of sell-side conferences. Companies go and meet investors after their quarterly results. You've got investor days where companies come and you're kind of exposed to the senior management. So those, earlier, go back 15 years, the only opportunity to meet up with the management for all intents and purposes was if you go at the AGM. So those two main objectives of the AGM no longer seem to hold.
Right.
Is it good or bad? I guess, AGM was a nice ritual to have, but are we losing something as a consequence? I'll kind of, I've not, to be honest, I've not been able to decide one way or the other. And partly it's because I don't know. If you don't, what is the alternate? At the moment, we seem to have, addressed two of the basic issues. Right. But does it mean that some retail participation is lost? Certainly. Is that good or bad? We'll wait and watch and see how this evolves. But it's not just something which we are grappling with in India. I think we are, the whole world is kind of grappling with some of these challenges.
So just let me circle back to, the responsibilities of the board and the board committees. And, there are two committees I specifically wanted to sort of get your views on. One is the Stakeholder Relationship Committee, and the other is the Risk Management Committee, and all boards necessarily have to have these two committees. And if you look at the Stakeholder Relationship Committee, I mean, are they really addressing the broader issues in terms of concerns of the employees, the suppliers, the wider community? So it normally, my understanding is that most of them see their role as just addressing shareholder grievances rather than anything else. Same is the case with the Risk Management Committee, because today, if you look at enterprise risk itself, so it is a sort of convergence of, ethical behavior, risk management, compliance, a whole set of things that come into, enterprise risk. And do risk management companies have a holistic view of risk in the company?
So let me come to stakeholder committee first. That's the one you asked for. So it was earlier called the Shareholder Grievances Committee.
Correct.
And it's now kind of got a different name.
Right.
Again, credit to the regulators. They kind of saw it as stakeholders rather than shareholders.
Right.
So earlier the role was very clear. We had physical delivery. I've kind of lived through it. So there was bad delivery, dividends not received because it's coming from the post, so on and so forth.
Right.
So, now that role is no longer there. So they need to, again, very clearly reinvent themselves.
Right.
So one is, of course, talking to the other stakeholders, as long as they recognize that their role is not limited to just looking at, a handful of shareholders. Because if you're saying that, look, I haven't received my dividend check, it's going to be 1 in 3 years.
So if I may interrupt you, are stakeholder committees actually talking to the other stakeholders?
So I'm not sure. It's not very obvious from my conversations whether they're doing so.
Right.
So what we believe is that, some things are easy. You've got an investor call, you should, at least dial in as a member of the stakeholder committee to listen to what's being said and what are the questions which investors are asking, because it kind of gives you a better opportunity when you're on the board to understand what is it that investors are thinking about. Are they happy? Are they upset? If they're upset, what are they upset about? And you can kind of then extend it to say that, look, I'm a company, I've gone to a trade show, are you there? Speaking to the senior management, speaking to suppliers. I know there are a couple of global boards, and actually also quite a few in India, which kind of, once a year will take a meeting at one of their plants so that you can walk around, talk to the employees and so on and so forth. So
there are companies who are doing that.
There are companies who are doing it, or they talk to or they go and say, okay, let's go to a different market, talk to our dealers, maybe talk to the suppliers. Have they embraced it wholeheartedly? No, but is there a realization that they should kind of talk to more? It's important. The other thing we've been kind of...
Does management see this as an intrusion?
Look, yes, for all, they're comfortable with some people speaking, not with others, which also shows that you want... if you're comfortable with some people speaking, not others, it means that, you need to revisit your board.
Right.
Who's on the board? Because why should you be uncomfortable if some people are there?
Correct,
of course, and you would expect there's some amount of alignment. They're uncomfortable if there isn't a complete alignment in terms of what happens. It's also, you have to recognize that, while board is listening to it, the board is not responsible for running the day-to-day.
No, they are not, yes.
So if some board members might kind of misinterpret it and take their responsibilities a little bit more seriously, which you then need to guard against. So it's a, you need to figure out how do you balance out between the two. But one of the things which we've kind of spoken about more recently is the fact that, look, and that comes from an earlier question on the share ownership. If promoters own 50% of the equity, most resolutions will go through.
Correct.
Right. I'm not saying all will, most will. And, we've looked at it over the last 14, 15 years. Of the 85,000 resolutions we've looked at, just about 240 have got voted again. So most resolutions go through, despite the fact that there is significant shareholder dissent.
Right.
So our view is that, look, maybe there is a case to be made that, look, if there is a shareholder dissent which is above a certain threshold, the board should actually try and understand what the reason is and explain themselves that why did they do what they did. If as a consequence they feel they've done the right thing, they had more information, a better understanding of the long-term strategy and therefore it fits in, by all means continue with it.
Right.
But if it needs a mid-course correction, you should do so. So it's we're not saying that you have to make a change, but you find that you've paid someone 150 crores, some pushback from the shareholders, but as I mentioned earlier, as a 50% shareholder, I've signed off my salary. It's now for the board to turn around and say, okay, we're going to reduce it now or
the stakeholder
next year.
committee.
Or the stakeholder committee can.
And what about the risk management committee?
So the risk management, again, you find it functioning much, much better in finance companies.
Right.
In the others, you find that there is, so finance, it's kind of, again, fairly well defined, what the data points you look at, what should you do. In others, it's less so. And if you kind of think about it, there are lots of areas which kind of fall between the gaps, and who should be looking at it. So just an example being that, if we look at the external environment, there are two things which stand out. One is geopolitical risk.
Right.
The second is that, just the battle for talent.
Right.
It's so difficult to find it. Who is the one? Now you can turn around, NRC can say one is my responsibility. But these are areas which the board should be looking at, newer emerging areas, a lot of it is to do with technology. So you had cloud, what does it mean?
Cyber
you
risks,
had digital, what does it do? Cyber, what does the company do? AI, how does the company address these issues? So I think the board needs, the committee needs to spend some time in terms of what should better define what their charter needs to be.
Right. And then equip themselves to actually address these issues.
That's right. Absolutely. Absolutely.
Amit, you've also, sort of done a lot of work in ESG, if I'm not mistaken, and you have a practice in ESG. So do you think Indian companies today believe that ESG is important, at least at an operating level? And from a proxy advisory firm for a perspective, how do you guide institutional investors in integrating ESG considerations into their investment decisions? I mean, do you have screeners that help them make these decisions? Or do you have some ESG ratings that help them make these decisions? And, talking about ESG itself, have we reached a stage where institutional investors can actually sit down with, managements and have conversations about ESG and tell them that, we as investors would like you to sort of adhere to these kind of principles?
So a couple of things. One is ESG was a much more hot button issue 3, 4, 5 years ago than it is today. Maybe because the America has dialed back and the American investors have dialed back. It's kind of lost some of its primacy.
So are you saying that the foreign institutional investors who invest into Indian companies no longer take ESG as seriously as they did before?
Well, I would say that, look, what they were doing so again, you have to look at different investors and different investment styles. So, so Europe was kind of much, much ahead of the curve and continues to be, except what they managed to do is, ramp up costs so much that people who were taking ESG seriously have had to let people go because it's now become very compliance driven. So it's kind of impacted. US, it's the politics on account of which they've kind of dialed down. The other is just the whole approach. So, you had again, you had different styles. You had, we began with what is called exclusions, and the best example of that was the Norwegian fund. So Norway said that, look, we've made a lot of our money in oil and gas. So when we invest, we won't invest in oil and gas overseas. And then it kind of extended, we won't invest in tobacco, we won't invest in, defense and so on and so forth.
Right.
So they kind of worked it out through exclusions. The Japanese pension fund got into this whole thing late. And they said, look, my investing or not investing in a coal-fired power plant is not going to change the equation for the world. So therefore, what I'm going to do is we're going to continue to invest in these companies, and as a shareholder, we're going to engage with the companies and say that, look, how are you transitioning out? Which I believe is a much, much better model. Now, India's had a couple of, India's kind of again got into the party late. we've never kind of embraced it. So there have been a few ESG funds, but
Right.
if you look at it, it must have totaled about $1 billion, $1.5 billion. There have not been a very strong case in terms of higher returns, so therefore investors have not really, so the retail market is not rushing into it. And then of course there's this whole issue of data. So we are what SEBI calls an ERP, an ESG rating provider. We've got license to do that.
Right.
And one of the challenges we continue to face is looking at the data and the quality of the data. So you have now, of course, you have the BRSR. But if I were to kind of just download it, it's either, I would say, 40% complete of, we can trust it to the extent of 40%. So what was our solution? Change it from looking at about 800 odd data points to reduce it to about 160, 180, where we then scrub the data, we kind of apply some judgment and clean it up. So now we are at about, but that becomes pretty intensive. So that makes it, there's about 75, 80% accuracy. It's not 100% there. Maybe over a period of time as, people kind of do BRSR for longer, the quality of the data will start to improve. But having said so, my own experience is that companies are ahead of where the investors are in terms of their thinking about ESG and ESG issues. So if you talk to them, they will tell you about projects they've run, whether it's a pilot project or something they've rolled out in the company. We met we were speaking to a tea company which was looking at, I think a tea or coffee, whatever.
Right.
The distance the tea has to travel before the final consumer buys it. So to try and figure out what the carbon footprint is.
Okay.
Their companies are tracking how much they're doing to packaging, etc., etc. So I believe that's happening. Will investors catch up? I'm pretty sure they will, because it's a very real problem. I mean, we are sitting today speaking, rains have come in much before, excessive rains, if there is something like excessive rain. But it's much more than what was expected, or much more than what you've seen in 15, 20 years. We'll kind of see the data in 24 hours or 48 hours. So all these climate change is real. It's a part of sustainability. So is the solution that you break up E, S and G? Maybe the mistake was that, you were looking at what is beyond numbers.
Right.
And therefore you said that, look, all this is, ESG is all beyond financial numbers, so therefore club it all together. Maybe there's a stronger case to kind of say that, look, sustainability should be looked at separately. Social livelihoods might matter to you, female education to me, infant child to, nutrition levels to someone else. So it's very difficult to say what is good karma.
Right.
It could be different for different people. And finally, G is something which all companies need to embrace. So I think the way it will go is that you will see.
So if I may sum up, Amit, you're saying that companies take ESG seriously today.
Far more seriously.
But investors are a little sort of indifferent to whether it is.
They're struggling in terms of how to interpret the data and what does it mean. Does it necessarily
result in better performance?
Better performance. And again, as in the case of G, my suspicion is that, look, if you don't have enough focus on environment, you're going to blow up.
Right.
It doesn't necessarily, it's a hygiene factor. It doesn't necessarily result in better performance, but the absence of it means that, you'll, whether it's today or tomorrow or 3 years from now, there will be some blowout, or suddenly you'll find that, look, everyone's invested, I haven't invested, regulations have changed, so I'm going to play catch up, and therefore you're going to struggle.
So Amit, I have a last question for you. There is a huge amount of asymmetry of information, among stakeholders. Like, for example, the institutional stakeholders, banks, etc., have got, better access to information. They've got support from proxy advisory firms like you. But the retail investors, unfortunately, even today, don't have access to the same sort of quality and amount of information relating to either the corporate or corporate performance. Right? How can we bridge that gap? Because at some point of time, as much as the institutional investors have started playing a more important role, in governance, I think the retail investors also should step up at some point of time and, play a role that is sort of meaningful.
One of the things we do is we kind of put out our recommendations in the public domain.
Okay.
So they go through some of the platforms, and what we've done is, I think from the middle of next month or towards the last week of next month, all voting platforms will have our recommendations. So what we promised is we'll give the summary. You may not get the
the details.
You may not get the 20 pages of it.
Right.
You may have to do a little bit of work, which is look at our recommendations, download our voting guidelines. We do that for the paying, some work, extra work, which we've all done for our paying customers.
Right.
But on the other, as far as financial performance is concerned, information, I think again the regulators and SEBI has done a great job in terms of forcing companies to push out stuff. So whether it is if I meet an investor, I will put up the presentation. If I go and speak at a conference, I will put up the presentation. There's a story about me, rumor verification. So if it comes out in one of the mainline dailies, the stock exchanges pick it up, and the company responds to that. So I think there is a huge amount of information which is out there. You have to recognize that, look, what is it that institutional investors are doing? They're doing their homework.
Right.
So why should the retail investor not do their homework? Right. They also owe it to themselves and their families to kind of do their homework and not just say that, look, momentum hai, this is something which my neighbor has bought, this is something which, I was on the, one of my colleagues bought. There are lots of, there's information overload. Different people may have different time horizons, different compulsions, different way of thinking about issues. You have to do your own homework. You have to figure out, look, does it fit in with my long-term, medium-term and long-term goals? Is it a risk which I'm willing to take? Is it money which I'm willing to lose? What is the quantity? And hey, what's really happening in the company? By and large, there's enough information out there. There are enough websites out there which are giving you information. So I would expect that the retail investors or the individual investors will and should do their homework before jumping into this market.
So if I may sum up, what you're trying to say is that financial information anyway is disclosed and is available to the retail investor. There could be information relating to non-financial issues which may or may not be available.
May not. Again, if you look at it, a lot of it is there. I think the issue is information overload.
Right.
The issue today is information overload. If you kind of...
So that's exactly where the retail investor is unable to synthesize this information.
That's right.
And maybe, proxy advisory firms will be able to support them in synthesizing this information to some extent.
Look, we are able to do it for shareholder notices.
Right.
But even now, I go back, when we began our reports were 8 pages. Then for a while they've been about 20, 22 pages. Now it's not unusual, it's because of the related party transactions, it's not unusual for us to have, 70, 80 page reports.
Right.
Now we are able to kind of distill what is happening on the related party transactions with all the information out there.
Right.
It's very difficult for us to do, but the good news is there are enough people, credible people, I'm saying. And what you have to remember is that you have to go by the credibility of how credible is the information source.
Yeah.
These rumor mills, etc., WhatsApp chats, etc., and go by, you may make 1%, 2% less, but at least you don't lose your money.
Thank you so much, Amit. That has been indeed a very fascinating...
It's been a wonderful conversation. You've touched on so many subjects and you've kind of, pulled out the best of some of what we've said over many, many years.
So thank you so much, Amit.
Thank you. Thank you.